Hey traders. I wanted to do a video today primarily because I'm bored as can be. We're waiting for the Fed at 2 o'clock today. I am sort of trading, but it kind of brought up a interesting thought for me that I thought I'd share with you guys, and that is how to use the VIX. Okay, now the VIX index, for those of you that don't know what the VIX is basically a measure of volatility as represented by options premiums. Okay, so just to give you an idea here, let me just pull something up here. So let's just say that I was checking some options premium. It doesn't matter, Apple. Okay. And let's say I was looking at calls on Apple, all right, and we were going to go 16 days out, and you can't really see it right here. I'll try to bring it closer. So let's say that you were looking at strike. Let's say you were looking at Apple's currently trading 168. And you can see that there's a 167.5 and a 170. Now, obviously, you have your calls. Okay, so the at-the-money call, which is the 167.50, is trading at a $5 premium. Okay, in other words, this is really worth 40 cents right now, but $5 of it, pretty much, is all premium. Now, on the other side, you have the 176.50 put, and this is trading at $5.20 right now. So again, about $4.80 is premium, right? Now, a lot of people don't really understand what the VIX is, right? I don't think they really understand it. So if the VIX was low, okay, now I'm not saying Apple specifically because each stock will have its own volatility, but if the VIX was low, Apple's premiums wouldn't be $4 or $5. They would be like $3 or $2.50, right? Assuming that Apple would be relative to the VIX at that particular point in time. So that's all volatility is, right? That's all the VIX is. The VIX is just measuring the amount of premium inside the options market on whatever, whether it's, the S&P 500 basically. So when you're looking at the VIX, okay, when you're looking at the VIX, what are you really looking at, right? What are you really looking at? Well, you're looking at how the market makers believe the risk inside the options market is. Because the reason premiums get high is due to the fact that the market maker believes that he must charge a higher premium in order for him to be safe. Okay? Because what a market maker does is he's the one that gives you liquidity, which basically means he's selling you options, and that's what he's willing to do. He's not willing to sell you options for cheap, and that is why premiums get high. Now, it doesn't have to be just the market maker. Anybody can sell options. So what it's saying is the consensus of the market is that there is risk in the market. So how can you use that information in your everyday trading, and how should you use that information? Well, you can see right now that we are at a fairly high level, at least historically. Let me go a little bit longer here. You can see that historically this is a pretty high level, right? And you can see only once, twice, 3, 4, 5, 6, 7, 8, 9, 10, right? Only about, that's not accurate, only about 7 times last year, the VIX went 1, 2, 3, 4, 5, 6, 7, 8, about 9 times the VIX spiked up to these levels, right? And the year before, you can see these spikes, they're rare, okay? And so a lot of people, they come up with trading strategies to trade this, and usually it involves selling options on the VIX, okay? Now, I think that's a really stupid idea because, as you can see, if there is a geopolitical event, you can get wiped out. I mean, let's say you sold an option at 12, right? And it goes to 54 or 100, and believe me, it can, right? And it will do it very, very fast, right? Well, you're going to get wiped out. Your account's going to get blown out, right? Now, I'm not saying don't sell options on the VIX or don't short the VIX because, as you can see, it can be a very profitable strategy. But you have to do it in a limited risk fashion, okay? In other words, if you were going to sell an option, you better buy some protection. So if you're going to sell a 14, you better buy a 16 and really do it as a spread, not necessarily a naked options trade, okay? That's just an account blown waiting to happen, okay? Now, how can you use the VIX in your everyday trading? Let's say you're a day trader and you're trying to make some decisions as to, how you should trade. So let's just go here. And today's a very good example. Now I want you to notice how the market has moved almost $1, almost $1, almost 80 cents, and almost $1. You can see here, see these big moves? Okay, so that is what is representative of a high VIX. Okay, start to use your brains here now, guys. Okay, now if I were to go way back and I were to look back, let me just go 20 days here, at a time when the VIX was lower, and I'm going to go to a 10-day, 30-minute. We should do a custom time frame here. So let's do it 1 day. I'm going to edit this, and I'm going to go back to a time, let's just say 30 days, a time when the VIX was lower, okay? So 1 minute, 30 day, 1 minute, okay. So if I go way, 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 way back to a time when the VIX was lower, okay, this is what you can expect. The market is relatively directional with small swings back and forth. Okay? Now occasionally it will trend. That's fine. You can have a trending market with a VIX, but notice that the pullbacks are shallow. Okay? So what a way to use the VIX that most people don't really understand is that you should use it as a way to gauge, number one, where you should enter trades. Should you enter trades at, say at shallow pullbacks, or should you enter trades at big pullbacks and wait for extremes? Okay? Hint, hint, hint here, guys. There's gold here if you pay attention. Okay? Doesn't mean the market's not going to trend, but when the VIX is low, you don't have to wait for big pullbacks to get in. Understand? Because the volatility is low, where when the VIX is high, you have to pick your spots very carefully because you're going to get whipsawed. Okay? So there's a saying in the investment community, volatility is a trader's best friend. Now, I hate that saying, right? I really hate that saying because you can make money in a volatile market or an involatile market. You just have to adjust the way that you're trading, number one, as far as your entries are concerned, and number two, where should you take profits? So, for example, in a volatile market, when I got short here this morning at 283.20 and we took out this low here, I didn't report it in StockTwits because I actually put on quite a large size trade and I took half of it off. I still have a position working. When we swing like this, I'm going to take profits back here and I'm going to add back in. And when we swing, I'm going to big extremes, I'm going to take profits and I'm going to add back in and wait for better prices to add back in. Wait for much deeper prices to add back in. Does that make sense? Right? So when volatility's there, doesn't look good here because it's leaving out the overnight gap, but when volatility's there, you can be very aggressive and you just have to wait for extremes before you take a trade and then hold those trades all the way to the other extreme. And then you can safely take the other side and then hold that trade to another extreme depending on what your bias is. Okay? That's the true use of volatility. You use volatility to time your entries and your exits. Okay? That is what it's all about. Do you wait for extreme levels or do you not wait and get in at relatively better prices that you don't have to be as patient with? And should you take profits fast or should you hold on to your winner? Well, when you've got high volatility, you want to hold on to those winners a little bit longer because you're probably going to squeeze out more of the trade. That makes sense? Okay, that's the true use of volatility. I don't know why people are trying to teach you that it's something that it's not. It's just the measure of movement back and forth that a stock will have, right? Pretty simple, guys. And just think about it. Think about it in common sense terms. That information is extremely exploitable if you understand that you have a high volatility market, you must behave and treat your trades differently than when you have a low volatility market. Okay? Now, if you're trading individual stocks, you might want to throw up an average true range as well too, and then you'll know that what the volatility is on an individual stock. Okay? Hope you guys enjoyed that. Don't think the VIX is anything else but what it is, and there's a lot of people out there that are trying to mystify it, but there's nothing to be mystified. It's really just a tool to help you gauge how you should behave and how you should treat your entries and exits. That's all it is. Okay? Hope you guys enjoyed that. Thank you, and bye for now.